up 180 points, up 0.4%, and energy, Nifty Energy, that continues to be among the top movers. Let's move on, talk about Anup Engineering. Anup Engineering has made an acquisition. Any deal specifics that we'll be talking about? What will the mix be of the company and outlook of the company going forward? To talk all about the company, we have Punit Lalbhai, Vice Chairman and Non-Executive Director at Anup Engineering, joining in with us. Thank you so much, Puneet, for joining in with us this afternoon on ET Now. Let's just start by talking about this acquisition, right? In terms of the acquisition of Mable Engineering, talk about the company first. Is this a profitable company? How does this add to the company in terms of the top line as well as the bottom line for Anup Engineering as well?
Yes, this company is profitable. It's also strategically very important from a geographical perspective, from a new product perspective, and from a capacity debottlenecking perspective. So it will add about 10% to our top line. It is currently at a 15 to 16% EBITDA, and we believe that it should give us about 60 crores next year. And then going forward, it should cross 100 crores and get into the EBITDA profile of 18 to 20.
Also, if you could tell us, with this acquisition, is there any debt that comes along, and how will the acquisition improve your product mix? Are margins expected to be higher post that?
So the acquisition is very strategic. It is focused on higher metallurgy and stainless steel, which on a per square foot basis is more rewarding because of the criticality of those equipments. In terms of the strategic fit, it will give us new products like silos, like site fabrication, containers that are not currently part of our product portfolio. It will also give us a much closer footprint to some of our very important customers in South and in capital goods. That's a big advantage. It will also give us some engineering capability, and it will also give us a capacity expansion that I spoke of earlier.
Okay, given that you have sufficient cash on the books, I believe that the acquisition actually will be funded via internal accruals, but any more such acquisitions that you would be looking at going forward?
So we are also expanding our Kheda facility. So we are going to complete the phase 1 of our Kheda facility, which should make Kheda, in terms of capacity, deliver 200 crores. And then added to that is Mable, which will deliver an additional 60 crores. So both of those, the capacity expansion at Kheda and the acquisition of Mable, will be funded through internal accruals.
Also, if you could take us through your order book, where does it stand? How has been the order inflow trend in the fourth quarter?
So the order book is at a very healthy place. We should end the year with an opening order book of 700 crore plus, which should deliver a 30% plus or a 25% plus growth for the next year. The capex cycle is extremely encouraging, both domestically and abroad, for our product portfolio. And we feel that it will remain so going forward. As far as Q4 is concerned, we are on target to achieve what we had committed earlier, and we are on budget.
Okay, that's an order book. But, Puneet, talk to us about the current demand trends as well. How are things shaping up both in the domestic as well as the international market then?
So as far as the demand is concerned, we are in a very positive capex cycle, especially as far as oil and gas and petrochemicals goes. There are a lot of investments coming both in India and abroad. We are also at Anup very focused on diversifying our segment mix. And we are now really focused on green and blue hydrogen. So almost 20% of the new order book is focused on that category. And we are also looking at the chemical industry and fertilizer industry to win more orders. And demand from all these sectors currently is pretty strong.
Well, talking about margins, with all the expansion and improving efficiency, what is your outlook for margins? Any guidance that you could give us? Is 27% doable for FY25?
No, I think a margin profile of 22% currently is the right margin to benchmark. As the criticality of equipment goes up, the raw material content also goes up. So EBITDA margin is not the right indicator. I think the margin that will consistently go up with an improving product mix is the amount of money we make per square foot under the crane. So that is constantly going up. But for overall EBITDA margin guidance, we should be in this 20%, 22% range going forward even. So we will maintain this margin and grow rapidly at 25% plus.
And with the company's strong focus on gas, petrochemicals, renewables and hydrogen, which segment do you think is going to be leading the growth going forward? Are there any new opportunities that you're seeing in any other segment?
So I think there is still a lot of demand to come in the traditional sector of oil and gas going forward, especially for the next 4-5 years. We see this demand remaining quite robust. But I think the newer renewable space is going to heat up as the world thinks of diversifying and changing over to more sustainable sources of energy. And hydrogen is definitely a key cog in that strategy. And so we will look to see how we can contribute our capabilities to that changing strategy of energy strategy of the world as it goes forward. But for the short term, oil and gas and petrochemicals still will remain a very important part of the product mix.
Okay, thank you so much, Punit, for joining in with us this afternoon on ET Now. It's always a pleasure having you on the show. That was the management of Anup.
If you like this video, then like, share and subscribe to ET Now.